So, hi everyone, and welcome and happy Valentine's Week. We are so glad that you will be joining us today. This session is going to be part two of our three-part accounting webinar series here at Staylist. So, our goal with this series is to help operators feel more confident in their financials and make smarter, more informed decisions as they run their business. So before we dive in, I'm excited to reintroduce today's speaker, Tyler Otto. Tyler is the president and owner of Specialized Accounting, which is an accounting firm that works exclusively with hospitality businesses. So before building his firm, Tyler held financial leadership roles at Vail Resorts, and he's been known for making complex accounting and tax concepts practical, relatable, and helps make stronger decision making. So before I hand it over to Tyler, I'm going to reintroduce Clyde Yelverton, which is Staylist's Chief Operating Officer. And Clyde's going to kick things off with sharing how Staylist is thinking about accounting and financial visibility for operators, and how these strategies kind of tie into the tools and improvements that we're continuing to build within the Staylist platform. So today we're taking a step further and focusing specifically on tax strategy and timing and how small shifts in that way, it can help your approach for accounting, make real impact on cash flow and profitability. So we'll wrap this series up with a final session on February 24th, which we'll talk about it again at the end, but feel free to ask questions and, we'll have Q&A at the end as well. So I'll go ahead and hand it off to Clyde. Thanks.
Thank you, Courtney. What an intro.
Yeah.
I'm not going to be as good as Courtney is on my intro, but I just wanted to say, as I had mentioned last time, we have invested a ton of time and energy and money and everything into becoming the leader in accounting. And part of that is taxes. Big part of that is rolling into that. So excited to present today, and I will not be interrupting you much, Tyler, but I do have some questions I'd love to ask throughout or even at the end just to hear your perspective on, and more through the lens of a PMS and how having solid accounting and solid tax structure within your PMS is important. And even learning, and would love to hear from the participants as we get into Q&A, hearing challenges that other people face, and as we continue striving to be the best accounting system in the hospitality industry, continuing to learn through that. I don't claim to be a tax expert, but I am pretty good at asking questions. So excited to hear the presentation today, and hear from you, Tyler, and I'll throw it over to you.
All right. Well, thank you, sir. Yes, everyone, as Clyde said, my name is Tyler Otto, or Courtney said, or both of them said, with Specialized Accounting. We specialize in accounting for the hospitality space. This is what we love. This is what we do. It's fun, and we get to nerd out in a space that no one else does. Today, Courtney kind of gave me a little bit of free reign here because, she's like, hey, let's do a three-part series. Last week or 2 weeks ago, we covered how Staylist helps you manage your books on accrual basis and why that's important and why it saves you money. In a fortnight from now, yes, because that's more fun than saying 2 weeks, we're going to be talking about metrics and how you can utilize the data from Staylist to really analyze and understand your business operations. But this week, I wanted to kind of detour a little bit away from just what Staylist does, because there's so much valuable tax info that first-time operators, or even sometimes seasoned operators, don't know and understand, and they're leaving so much money on the table. And so I kind of wanted to hit just a big five today and really go in some strategies that are easy saving. So I'm going to share my screen real quick. Assuming I share the right one, you should see a very pretty presentation that someone on my team made pretty, because otherwise it would look like I did it in Microsoft Paint. And along the way, if there's questions, throw them in that Q&A or in the chat. Courtney, Clyde, Nick, feel free to interrupt me. You won't throw off the Emperor's Groove while he's going, so please interrupt me as you need to. But today's agenda, everyone, we're going to be covering a few things. First off, if you are getting started, you're thinking about buying a campground, glampground, hotel, RV resort, some of the early things you can do that are really going to pay off long-term, laying down that foundation of your financial structure for your business, as well as some other key strategies to save on taxes. We have a lot of things we like to do, and they're easy wins for you. and talk about, not all these strategies are for everyone. So when you should consider them, when you shouldn't, when it's just wasting your time and money. There will probably be 2 dad jokes, maybe 1 actual joke, and at least 3 '80s pop culture references, just knowing how I roll. Just looking at the camera, Clyde, you would appreciate the one. What do you call 10 rabbits standing in a line walking backwards? A receding hairline. There you go. You're welcome.
I was
All
trying
right.
so hard. I was like, I know it's hair something.
I was
I
looking at
loved every
myself and that
second of that,
joke just
Tyler.
came back to me. This is the background. The auto background is cutting off what little extra hair I have, making me rethink my life choices. But let's move on. All right. So today, before I get started, I have to say this 95 times because I never want to get in trouble for pretending to play lawyer. But the world of tax and the world of legal goes so hand in hand. But I'm sure many of you have experienced where it's like your lawyer's like, well, do this, but talk to a tax professional because we're not sure what that means. And then your accountant's like, here's what you do, but you should talk to your lawyer about the implications. We're going to cover both, but I am not the lawyer. So please don't think I am giving you actual legal advice. Confirm it all with your attorney. But all of this goes hand in hand, and I want to give you as much info as possible. So first off, I want to talk about entity selection. Oop, and I'm going the wrong direction. So many of you starting out your business, actually, before we even talk into, let's just say what the basic ways you can structure your business are. If tomorrow you had a piece of property out behind your house and you start renting RV pads, you don't establish a business, you just start accepting money from anyone that is willing to drive onto your property, you're a sole proprietor and you're going to file your tax return on a Schedule C. Now, some of you are like, oh, Tyler, you're already talking tax returns. I'm zoning out. And I'm sorry. Give me 2 minutes. If you already know all of this, go play Candy Crush and then come right on back. I promise this is going to save you money, but we got to do a little foundational groundwork. Next up, if you and some friends decided to start a business, but you didn't set up a company, bad business owner. Stop it. Go get a company. We'll talk why later, but bad on you. Don't do this. It's a bad idea, but you'd be filing a partnership tax return. Then you might have heard of these fancy thing called corporations. Corporations don't pay taxes at the individual level. They pay taxes at their own level. And you're not really going to play with this much, but we need to address it because I want to talk about one of my favorite strategies, which is when you have a basic company, an LLC or a limited liability company or a limited liability partnership, general partnership. There's so many different types you can have, but it's a basic legal structure. And if you own that by yourself, you're still filing a Schedule C. No problem on your personal tax return. Not a big deal. If you and some friends own it or some business partners, you're filing a partnership return. No big deal. But the first thing I want to talk about is whether or not you're a corporation or an LLC, you can tell the IRS that, hey, I want to be taxed like a small corporation, IRS code subchapter S, and I want to be treated as this special little entity called an S corporation. And it's a fun little tactic because whether you're a legit corporation or an LLC, you can choose to have your business taxed this way. And I want to walk through real quick why this is such a big deal for business owners. Because let's say you, again, just start a business by yourself, you have a company, and you're getting taxed like you're a sole proprietor. Well, let's say this year you make $100,000 in profit. Cool. The first time any of you go to get your tax returns done, you're going to encounter the beast that no one plans for, which is that darn pesky self-employment tax. I hate it when this pops up. Because you don't have a W-2 job and you're not paying payroll taxes, the IRS says, well, you're going to pay your payroll taxes at the end of the year. It is 7.65% for the employee and 7.65% for the owner. Since you as the business owner are both, you're going to get hit 15.3% self-employment tax. And that's before you pay income taxes. That, in the technical term, is what we call that sucks. So, what we like to do, again, is this fun little strategy called the S Corp, where you can elect for this business to be taxed as an S corporation. Candy Crushers, if you tuned out, come back in, because this is the valuable part. Now, we're going to take the same 100,000 we had right here, and we're going to pay ourselves a W-2 wage throughout the year. Yeah, you're running payroll software, spending a couple $100 on it. But let's say we do a reasonable compensation analysis. We look at what, someone running a campground or a glampground or a small hotel, what should they be making? Maybe we figure out that's 50K a year is the national average. Cool. You're going to pay that 15.3 self-employment tax and payroll taxes. But what happens to this other magical 50K? Well, that gets distributed in profit. And because you've already taken your self-employment tax on half of it, the other half comes out self-employment tax free. Ta-da! We just filed a single piece of paper and made $7.5 grand appear. Like if I could pitch anything better for why tax planning is important, this is a $200 form for me and my staff to file to produce $7,500 in savings. Like that is a slot machine I would play all day, every day. So, I want to talk about why this is helpful, because obviously it avoids the self-employment tax, but there's a few downsides, right? Because there's always, the other terms and conditions may apply. Yes, you are going to have to file an extra tax return every year. Depending on the business, maybe you're spending $1,000 or 1.5 to do a tax return for this S Corp every year. All right, let's say it. And then on the high end, let's say you're running a payroll software for $400 a year. Highest case scenario, you're spending an extra $2,000 a year for payroll in this S Corp. I would gladly spend $2,000 to save 7.5. If you wouldn't, I don't know why you're running a business, because these are the trade-offs you make. Simple, easy money back. Now, there's a few other things, and I'll nerd out to why this is important later. But as with all good things, it comes with terms and conditions. If you are paying your kids, and there's a fun little trick we're going to cover, S Corps can't do this. There's a workaround, and we'll talk about it later, but just know I'm talking about it. Also, if you take a home office deduction right now in your sole proprietorship, you can't do that in an S Corp, but there's a workaround. We just have to call it by a different name, and we can still do it. If your tax professionals know what they're doing, it's called an accountable plan. And then, yes, you have to pay yourself a reasonable wage. This 50K has to be backed by either you're finding comparable jobs on Indeed or Monster or whatever. Maybe you're going to Craigslist, but you have to be able to prove it's a reasonable wage for the roles you're doing. We have Department of Labor and Statistics data we can pull from their database to help our clients prove that they are paying themselves a reasonable wage. But those are the downsides. I mean, talk about easy strategy 101, but any questions on this, attendees or fellow presenters? Nailed it. All right, and we'll keep this party rolling, because this strategy is my next favorite one. I live in Utah, where some people think tax savings is just have more and more kids. Yes, I've got neighbors down the street with 11. Don't know how they do it. And that $22,000 a year they get back in tax savings does not come close to paying for those kids. But as a business owner, you have the unique opportunity to utilize your kids for tax savings. So let's just imagine a scenario like this, where you've got your company, your campground, glampground, your RV resort, and you're making $100K a year again. Now, in all actuality, if we do the real math on self-employment tax, you get to deduct a little bit from your income. So it's really going to be around $14,000 when we do the math. But you're going to pay $14K to the IRS. Then you're going to have to pay income tax on the remaining profit. We're talking $21,000 in taxes you're going to pay in that year just for running your business. And then if you got kids like me, I'm still paying for soccer and drum lessons and school fees and all this other crazy stuff. And it just annoys me to no end. But as a business owner, we can do some cool stuff. If our kid is under 18 and dare I say 7 or older, some people will tell you 6 or older, maybe 5 is flirting too much with the line where the IRS gets suspicious. But 7 or older is a safe number where you can employ your kid in your business. And I do this in my accounting firm. I get tons of documents, paper, where they need to be scanned in the batch shredder. They need to be, batch scanner, then shredded. Then the office needs to get dusted and vacuumed. And I'm going to pay my kiddo a W-2 wage for doing all of that, for helping in the house. Now, I can't pay him $200 an hour, but I can pay him something reasonable, 20, 25 I can maybe get away with if that's what I'd be paying to get it done in the open market. And when I pay my kid those wages, his W-2, because of an IRS carve-out, he pays 0 in payroll taxes. That self-employment we had over here for us as the business owner is not there when we pay our kids. If it is your own dependent, you are free from paying any payroll taxes. This goes all the way back to back with early immigrants in New York, and you would have, the whole family working in the business. Or if you ever watch Kicking and Screaming, Nick, you already hit us with a Will Ferrell reference once today. But the Italian kids, meat comes first before they can play soccer. Yes, it's that exact scenario where you pay your kids in the business before they can go whoop others in a game of football. But the cool thing after that is then you can put the money in the kids' bank account, and then they will pay income taxes on that amount. Well, they're making under the standard deduction. They're at a 0% tax bracket. Your kids are. So they don't even need to file a tax return. So you just saved, if this was $10,000 that we paid them for the year for helping us, just doing basic work, maybe at your campground, they're helping pick up trash and they're going through and helping, sweep floors or do some basic cleaning. If we took 10K out, we would still then be able to pay from that bank account for drum lessons, soccer, school fees, even part of groceries, spend it on the same stuff we're already spending it, and save $2.5 grand in taxes on that 10 grand we paid them this year. And it's just as simple as just documenting the work they did and keeping track of it and paying your kids. This is one of the easiest things as a business owner. And if you took this to the max, you're doing standard deduction every year for kids, you're talking $3.5 grand in savings per kid. For me, that'd be $7 grand back if I was able to max this out. Now, my 5-year-old is not at that age yet. I want to mess with the IRS, but you got to believe in the next year or two, he's going to be working in my business as well. So super fun strategy. A few of the pros and cons I do want to hit on is you do get to spend that money in their bank account on expenses you're already incurring. Like, no big deal. You avoid the FICA. And here's the cool part. For those of you that know of investing in your own retirement, if you contribute to a traditional retirement account, you pay taxes when you distribute. If it's a Roth account, you pay taxes right now at your current tax rate. Well, my son, Porter, which, by the way, my kids are Porter and Luke. As an accountant, I just realized I named my kids P&L. Yeah, I really should have thought that one through. But Porter right now, that is earned income for him. So we can choose to contribute his earned income to a Roth account. Well, he's going to pay taxes on it right now. What's his current tax rate? 0, which means that money will grow for the rest of his life tax-free. Talk about building generational wealth. This is how to set them up long-term forever. Don't worry about contributing to 529s. Put it in here, because if it's a Roth account, whatever you contribute, the principal, you can take out whenever you want in the future, penalty-free. You can't take out the interest earnings, but you can take out the principal forever. This is an amazing strategy to help out your kids. And even better, we can take this to the next level, because we can do this for nieces and nephews. Same thing where it has to be paid out to your own kid. Well, I can't pay my niece, but I could pay my brother, and my brother could pay his daughter. My brother would record $10,000 in income for the year on a Schedule C and $10,000 in expense. So his liability is 0. And now his niece my niece, his daughter just got 10 grand tax-free for helping in the business. Same things goes with grandkids. Like, there is so much you can do here with getting the money out to kids under 17. Now, there's a few caveats because people try to go a little crazy here. First of all, the work needs to be reasonable and age appropriate, right? You can't have your 7-year-old working jackhammers and heavy leveling equipment and saying they're getting paid $50 an hour. Now, it's got to be reasonable. OSHA shouldn't have any complaints with what you're doing, but some basic administrative work, especially scanning, shredding, cleaning, picking up stuff. It's super simple. And I look at my nieces, man, I should just give them full control of all my social media because it feels like they got that down anyway. So there's plenty you can do here that's appropriate. The rules do change when they go over 18, because now there is not that exemption for free of self-employment tax. You're going to pay it. You're going to issue them a 1099. But if you're still supporting your kids that are over 18, if you're already paying for their expenses in life, might as well still get the money out of your tax bracket, which is hopefully higher than theirs, and then still pay for the same expenses. Instead of you paying for their student housing and rent and any groceries, pay them through the business for doing work, and then they can pay for all those expenses at their tax bracket. Same money going out to support them, a great way to do it. Another technical term in accounting is we document the hell out of everything, because if an auditor comes out and says, hey, prove they did this work, you want time logs. You want to be able to say, yep, this is what they did and when. and you actually have to pay them. You can't just go on paper and say, well, this is money for my kids, so I don't want to pay taxes. No, you got to move the money out of your bank account and give it to them. The rules say from the IRS you need to issue a W-2. Spoiler alert, every tax lawyer I know and love says the IRS doesn't care. This has never been an issue, but the official rules say issue the W-2. And because I'm on a recording here, I'm going to say what the rules are. And lastly, as I said earlier, corporations don't have kids. That whole S Corp thing I talked about, that's true. But there's a ... for a reason, because there's a very easy workaround we can do. I'm not going to get into that here, but it is a great strategy, and your tax preparer should know exactly what they're doing. I'm going to stop again before I hit the next topic, but did I either overwhelm y'all or any questions on this?
We do have one question. It says, can you put them on salary or do we need to track hours and do an hourly wage?
Oh man, putting them on salary is going to be sketch because the IRS is still going to ask for proof because so many people have ruined this game for the rest of us. I had one client that came to me and said, hey, what's the standard deduction this year? And I think that year it was like 16.5 or whatever, 15.5. And I'm like, well, that's the standard deduction. Like, cool, that's what my kid worked this year. Dude, any auditor, all they have to do is just say, hey, look for people that did exactly the limit, and like they're going to come audit you first. Don't be dumb. Like, track the work, track the time. You don't want to, and doing salary, especially if you do salary exactly to the exemption, any auditor is going to see what you do and they're saying, cool, prove the kid did the work. You could do salary, but you know, that's going to be a risky scenario. I wouldn't do it. I would track the hours and pay out accordingly. Any other questions?
Looks like that's all we have for right now.
All right. Keep this party rolling. All right. Next up, you guys may have heard of this wonderful thing called a cost segregation study. Again, I am at risk of putting you all to sleep, but I get nerdy and excited about this stuff because this is numbers saving us money. I'm going to pause for dramatic effect 1 second. All right, so cost segs. These are absolutely amazing because first off, when you go to buy your business, we have to do this crazy thing called figuring out your fixed assets and depreciating them over time. If you don't know what depreciation is, essentially we just say, hey, you have a $100,000 vehicle asset building. The IRS won't let you expense that all right away in some scenarios. We have to spread it out over its useful life. And I know many of you that know enough about taxes, you're like, but wait, what about? And I know, we're going to ignore all of those. We're just going to talk about the rules right now. So let's say you buy a property for 1.4 million is what the closing docs say for land. And maybe the building is 1.2 million and furniture, fixtures, and equipment is 14,000. And so if we were to do the depreciation on all of these, well, a long-term hospitality business depreciation schedule is a building has to be over 39 years. You're spreading out that cost. That's a long time. Furniture, fixtures, and equipment, that's a 7-year asset, but you got to spread that 14 grand over 7 years. So right now, even though you spent 2.6 million on that building, on that property, you only get to expense 32,000 each year in depreciation against your income starting out. That goes down to 30.7. Well, we have this magic thing called a cost segregation study, where some really smart engineers or different teams are going to come in and look at this 2.6 million and say, yeah, I don't think that's how this valuation should have gone down. Instead, let's take a look at that property again. Oh, and by the way, the tax savings on all of this would be about $5,000 a year to start out if we assumed a 15% tax rate with all you get to depreciate. So $5,000 a year, remember that to start out. So your engineer is going to come in and say, I'm going to look at that 2.6 million, but we looked at everything and we think the building is actually just over $1 million of the value because there were some computers on site. Those were a 5-year asset. And there were some vehicles included in the purchase that weren't broken out. Those are 32,000. Machinery and equipment, land improvements, furniture, fixtures, and equipment was way off at 77 grand. And now you'll notice we start depreciating some of this money we pulled out of the building value at faster schedules, which means instead of expensing 32,000 a year against our income, we get to expense 55,000 a year to start out against our income. Well, if you expense more, you record less in profit. So if we were to assume a tax rate we are saving 5 grand a year without a cost segregation. We're going to save 8 grand a year for those first couple of years with a cost seg study, saving us like 3.5, 4 grand a year. And the beauty of this is not that we're actually saving money, it's that we're stealing from the future. We're going Marty McFly with our hoverboard, jumping in our DeLorean, and stealing dollars from 30 years, 39 years from now. I wish I could do the math quick and tell you what year that would be. But we're stealing money from the future and bringing it back now, and now we get to earn the interest on it. We get to get the growth. And interest over 40 years, I mean, if you just think investing it in the market, rule of 72 says your money should double every 7 to 8 years at a 10% market. Like your money is going to double 5x, 5 times over the next 40 years. Absolutely, I want that dollar back. So this is a fun little strategy to show you what this would look like. If we didn't do a cost segregation, we would expense around that 32 grand a year, get 5 grand in savings. But if we did a cost seg, we'd get to expense that much more every year. And our cost savings are dramatically increased with an extra 4 grand in your pocket every year for the next 5 years, another 3 grand, whatever, 2 grand, the couple years after that, getting money back. Awesome strategy. And I will say that the goal here is if you get this cost segregation study done early, you don't need to take all these savings in year one. Maybe you bought your property and you're running at a loss in year one. You don't need these savings. Like you don't owe anything in taxes. Cool. Let's sit on it in your back pocket and we can implement it in year 3 and catch up on all of it. There's lots of cool stuff we can do. So if you have questions about cost segregations or how to connect with a firm that does these, we have plenty of recommended providers we work with, and then we're doing the back end strategy. But it's a super cool strategy and one to think about before you buy your property. Any questions here? Clyde, have I touched on anything you wanted to ask about yet?
I have a question for you. So how does this change if you're running an accrual accounting versus cash basis? I'll ask that first.
Yeah. So IRS gets nitpicky here because whether or not you're on accrual or cash basis, counting your fixed assets and depreciating them over their useful life is a non-negotiable to the IRS. This is accrual-based accounting, and you don't get away from doing this, even if you are cash basis. So if you are expensing everything and not doing some special tax games we do, which those of you that are probably out there being like, but wait, Tyler, there's bonus depreciation in Section 179. And yes, there are some games we could play, but you have to be doing this, or if an auditor catches that you're not, you're looking at back taxes, penalties, and interest, which also sucks. Good question. What else you got, Clyde?
What happens when you own a number of properties? How can you share the tax benefits, or how do people need to think about that? I was going to ask earlier on the entity selection as well.
Yeah.
We didn't really touch on some of that.
So, I mean, you just asked a question where you thought there was a simple yes, no, but oh my gosh, we could spend 2 hours here because it really depends on the IRS taxes you differently on if it's passive income. Let's say you're just a money investor behind a property, you're going to pay different tax rates than if you are an owner in the business and you are actively working in it. That's active income. And so we can't take losses from passive and offset them from active income. So first you have to know and talk with your tax strategist on what each type of income each property is going to be. Now, let's say you're a serial investor and they're all passive. Yeah, you could take losses from one of your properties, offset income from the other. I worked with several firms where their goal was to buy 1 or 2 properties a year because it was like a snowball effect where they would buy something this year, take a ton of depreciation losses by speeding it up, doing cost segs, and then throwing in Section 179 in bonus, get tons of tax savings this year, use that money to buy another property, and then the next year they'd use the savings from that one to buy another one. They were constantly just stealing from the future. Eventually, the bill will come due in 30 years, but if you sell one of your properties at a huge profit, you've just made enough money to offset all of that money you stole from the future. So there's really cool strategies, but nothing happens in a silo. Either everything needs to be active, everything needs to be passive, or you have to qualify for this goofy thing called real estate professional status. And that's, again, a whole nother 2 hour webinar if we want to get nerdy. So, yeah, there's a lot in here. I love these questions. I just listen to myself and I must be the worst dinner party guest. Like, imagine getting stuck in a corner with a beer talking to me.
I love it.
All right. Any
Uh,
other questions out there?
is there any benefit or relation with USally, running with USally and chart of accounts on USally for tax strategy?
So for tax strategy, yes. When it comes to like this in the cost segregation, not necessarily. For those of you that don't know, Clyde was talking about USALI, this pops up, the Uniform Systems of Accounting for the Lodging Industry. Yes. And this is the playbook. This is our Bible. This is what when I worked at an 80 million a year, 5-star luxury hotel, back down to running a 2-star motel for $250,000. Manage them all on USALI. You can compare apples to apples. Yes, with figuring out what we can capitalize sometimes, there are some benefits. There's also benefits on playing games with what we can accrue, what not, what we can consider prepaid expenses. USALI does help with that a little. But regardless, even outside of USALI, the cost segregation is done even before you start making a dollar, which is really fun. So yeah, this is honestly industry agnostic. Even if you're not even in the campground space, let's say some of you, because I know many of you are serial entrepreneurs and you have some other business. If you have a lot of assets you bought in that deal, you should be looking into this.
Yeah, I was thinking more just financial reporting, I guess, if you don't do a cost segregation study as well. Um, Not
Yeah,
specific to cost segregation.
not as much on this one, on the tax saving side. The USALI benefits are all going to be in deferring income and pushing stuff into the future of recognizing income, and that's where I love USALI. There's plenty of tax benefits there. Super cool stuff. Okay,
Cool.
I'm going to keep this party rolling for you guys. Let's hit on one or two more. Oh yeah, and I didn't even hit on all the rules of the cost seg. Just because, again, I like to cover my bases and not have anyone come back and say, hey, Tyler said otherwise. I'm going to say with a cost segregation study, if you have a nitpicky lender, always keep them happy. I say that because, maybe or not, I ran into this one goofy credit union out of Salida, Colorado that had really strong opinions about how things should be valued and threatened to call the loan due. Don't know why, but I'm just saying keep your lenders happy. And in all the time I've done taxes, that is the only lender that has ever cared, but I'd be remiss if I didn't warn you guys. For those of you buying a property, if you ever get this question, come back to this webinar. This is where it's valuable. But if you get to value the property, you would always have it be goodwill, meaning you just overpaid for the business rather than it being part of the value of the land or building. Because then you get to at least write it off and expense it quicker than the land or the building. But if you can, you always want a cost segregation to make it like vehicles, furniture, fixtures, and equipment, machinery, anything like that. I recommend getting a cost segregation in year one, but you can hold it in your back pocket. Just know like there is no technical limit when we can all of a sudden say, okay, we're going to cash in our chips and take the benefit, but the benefit starts to disappear after around year 7. So just keeping that in mind. I got one more big tip I want to hit on before I open it up for questions on this. But interrupt me if there's anything else. Doesn't look like there's questions yet, so I'm going to hit it. Okay. We talked earlier about S Corps can't have home office deductions, and a lot of businesses can't, but we can just call it by a different name, right? We can call that duck by something else, and it's called an accountable plan. And an accountable plan is basically just you have it in your business meeting minutes somewhere that you decided to pay back one of the shareholders or owners or employees, which is likely you, and you're going to pay them basically what equates to a home office deduction. And it's basically a written agreement saying we're going to reimburse for certain costs, like part of their house or their vehicle mileage traveling between work-related stuff or their cell phone or the utilities of part of their house where that's equal to what they use for the business. And it allows us to then get all these expenses back as business expenses. And the cool thing is, as long as you document that as part of your company policy, you can choose whether or not to take a percentage of your home square footage. So, like if you had 1,000 square foot house and 100 square foot office in it, you could take 10% of everything you spent on your house, and now it's a business expense. So I'm talking gas, utilities, water, phone bills, the solar panels you put on last year, the repairs and maintenance costs you did, the lawnmowers you had come in. All of that can be offset against your taxable income. And I use this word lightly because I know it can be very triggering word, but in the tax world, it's not a derogatory term. But these plans can be discriminatory because when we talk about like 401ks and like retirement plans, you cannot discriminate which employees get it and don't. It has to be applicable. Accountable plans, you can just say this one employee gets it, which usually is just the owner. So it's a really cool benefit because you can just pick and choose, and it comes out as a reimbursement, not a taxable interest. So let's look at an example. What we use for our team is we're going in throughout the year and filling out what have they paid in, real estate taxes, homeowner insurance, gas, heat, water, electrical, internet, the solar panels, if that was on there, garbage disposal, like you name whatever you want that's a house expense. And we could say, cool, they have a 200 square foot office in a 4,000 square foot house. So that's going to be 5% of whatever they spent for the year. If we add that up every month, they're saving 2.5 grand on their income they're reporting that year by just reimbursing themselves for the business. Or you could do a simple method, which is just $5 per square foot. That'd be $1,000 for the year. That's the cheap and easy way, but we like having our clients do this, finding an extra 2.5 grand to write off right away. So if your accountant isn't doing this for you, you should absolutely be talking to them about an accountable plan. It's pretty friggin' awesome, in my opinion. Any questions on this, on like what you could allow or what you might not allow? Because this is usually one where people are like, I want to write off my dog's Beanie Baby collection. And it's like, no, we're not going to do that. But people usually always have questions here. Nick could totally write off his cool new blue blocker glasses as a business expense. Just saying.
I'm going to hire you, Tyler. That's
Thank
what
you,
I like
sir.
to hear.
Hey, we got some questions. Or do we?
They're just comments from Amir.
Okay.
I can read them if you'd like.
Hit us with what you got.
Or we can hold those to the end. We do have one that says, "How about storage in garage or shop?"
Ooh, I like this question. Okay. So, storage in a garage or shop. Yes, if you are using it for business purposes. This is honestly the interesting game because if I were to calculate the square foot of my house, I don't keep any stuff in our garage. So I am not going to include the garage in the square footage calculation. I'm just going to say, yep, our house is X thousand square feet. That's it. But if you're using a good portion of the garage, it might be worth then including that in the square footage and then, including that both the numerator and the denominator if it helps you out in deducting portions of the house. So it's a fun game to play if we can incorporate that. Yeah. Tools, for example, if you're using it for the business, absolutely we can do that. There's just a few quality control boxes we'll want to check along the way. Anyone else? All right. Well, I might hit one last question or one last topic real quick, and then we are going freestyle, however Clyde and Courtney want. The last thing I'll talk about is we talked about those fixed assets, right? And what you're going to depreciate. And the fun part about it is when you are buying your property, you got to think about what your goals are. Because if you decide that, hey, I want to save on taxes, the IRS safe harbor will actually allow you to expense any asset if it's under $2,500. So that's reducing our income. So if you buy a computer under $2,500 or anything else that should be depreciated over a long time, you can save in taxes by expensing as much as possible. It will reduce that taxable liability. Now, the one thing it will also do is make your financials look less profitable, which most of us don't care. Like it's all on paper. But if you're going to sell in the next 3 years, you might not want to do that. Now, depending on who the broker is and who the buyer is, they might see through this game. But we could say anything over $500 is a fixed asset and depreciate it out over a longer term. What that will do is reduce our expenses this year, make the P&L look a lot better. And again, I'm not talking about Porter and Luke here, but it'll make the P&L look much better for the prospective buyers and therefore maybe get you a higher return on the sale. Just know you might pay a few more in taxes the next couple of years why this happens. So one policy we absolutely love to talk about with our clients. All that being said, I hit you guys with a lot of nerdery. I know. What I can say is find a tax advisor, whether, some people like people in their state, particularly Californians, New York, Oregon, just because they have some goofy tax laws for their tax preparers. Find someone you like and know that knows this space. If anyone's saying they have a blueprint for every business owner, they don't. For example, if you bought your property with a ROBS, a rollover business startup, which is its own separate lesson as well, like people could really steer you wrong and ruin your retirement accounts doing that. So just know if a tax advisor wants to offer strategies, but they're not willing to put their name to the tax return, that's a big red flag that you shouldn't do anything they say because they're willing to be like, I'll charge you money for this, but I'm not going to put my name behind it. Like, you should be scared. And then lastly, I'll just say this over and over. Pigs get fat, hogs get slaughtered. Like, eat up as much as you can. But guys, if you are trying to max out your tax savings, go right up to that standard deduction, falsify information, just trying to get as much as you can, those are the people that get caught doing shady stuff. So play by the rules of the game, right? If you can only pay your kid $9,000 this year for doing work, pay them $9,000. Don't try to push it up to 16,000. Play the game right. Take what you can. Pigs get fat, hogs get slaughtered. And with all that said, that is my tax nerdery I wanted to hopefully enrich your lives with. Any other questions, comments, concerns before we tease metrics in 2 weeks?
Doesn't look like any questions in the chat, Tyler. I do have a quick question though. As we start to see more of like AI become involved in automation, where do you see that kind of changing accounting and maybe tax workflows in hospitality?
Yes. I mean, AI is the most productive entry-level employee I've ever had. It spits out the most work and causes the most errors of anyone on my staff that requires oversight and review. I would say simple calculations where it's just like, hey, sales tax. It's easy because it's always just a calculation on this. Let's get it submitted. There's going to be easy things to do there. But, I don't think in the world of like income tax planning, I would steer clear. I had one client that, they went through an AI bot to do their tax strategy planning and it said, hey, pay your kids this, do this. But the bot didn't remember to check, which is something we do on, is your kid on Medicaid? Any disability? Because earned income disallows their Medicaid and that kid lost his health insurance because they followed the tax strategy. Wow. So there's a lot of stuff where it's like, I look at the auto industry. We once had thousands of people working on the assembly line and they all lost their jobs and got replaced by robots, with a very highly skilled person behind the robots, overseeing it all, quality controlling, maintaining the systems. And we all look for that. Who was the inspector overseeing it? The role of AI is going to come in and replace those data entry level roles, but it's not going to replace the need for someone that understands the systems, processes, and the requirements that go into, securing your tax situation.
Cool. Thank you.
Good question.
Awesome. We do have a question in the chat. It says, can you speak to hiring kids opportunities and LLCs with more than one owner? Let's say they are all family, mom, dad, granddad, etc.
Okay, so this gets into a much harder situation because if it's multi-owners, you are going to have to issue the W-2s for the kids and you don't get these benefits. Now, what we like to do, and this is where I said there's a workaround, there's a fun thing you can do called a family management company, which is going to be a separate $300 tax return. But on top of that, you can then have a company that manages the kids. It's solely owned by the parents. And if the kids are doing the work and the parents are providing the guidance, the support, driving them there, they can say, hey, this is our business. So I'll accept 10 grand from the partnership to manage them. I'll pay 10 grand to the kids. My Schedule C shows zero in profit. and now the kids get the benefit. But to get that exemption on not paying payroll taxes, it has to be wholly owned by the parents. Good question.
Awesome.
Well, we just
All right.
scratched the surface. I hope I didn't put you all to sleep, but I find this fun. I mean, this is money in the couch cushion, guys. Do you ever get that pair of jeans out and find $100 in there from 3 years ago? That's what this is. It's the fun stuff.
Tyler,
Honestly,
the
that's
only
the
thing
best.
that really resonated is the child labor, just because I grew up working for my family lumberyard, and I'm pretty sure my mom was an accountant, so I'm pretty sure she was taking advantage of all of that.
Yeah. Did you
I was
ever
gonna
like
say I
also when
pulled
they go
out
like, "Where's my Roth?" though?
I do have one. They did set one up for me, so we're
Hey,
good there.
There you go.
guys, I will say this is one of the easiest things. It's intimidating thinking like, how do I do that? Literally, like I went into the Fidelity app to see how easy it was. It took me 8 minutes to set up a custodial Roth IRA for my kid.
Mhm.
Pay it out to there. Like it is not a hard thing to do.
Yeah, it was super simple.
Yeah. And might I answer one other question? Because there might be some of you listening to this webinar that are like, hey, I have a W-2 job. I'll pay my kids as well. Sorry. Can't do that. That's not how it works. You have to be a business owner paying them out of the business you wholly own. So you can't have this idea of, oh, cool, I'll just create a business and do that. No, you're going to get struck down. It has to be, the income has to be coming from a legitimate business that you wholly own. So sorry, W-2 owners. Womp womp.
So I have a question on unit types and how taxes are handled there. So, you know, how have you seen taxes been handled and calculated within a property management software with different units or even length of stay? And how would you
Ooh.
expect a PMS, to act versus, leave it in a tax professional hand to calculate like yours?
This is a great question because I mean, I would say you should consult with a tax preparer, but you don't need a long-term relationship for sales tax. But yes, sales tax is scary because the state could have their own rules, the county can have their own rules, the local province could. I mean, the city of St. Louis has a tax for like these streets, but not these ones. Like it can get as goofy as can be. And so for that, yeah, like Nick, I saw that look, but when my client said, hey, like if you're in these blocks, you have this extra 1% for a revitalization tax. Like it's so complicated. And then it's like, if do you have a restaurant component? Now you've got liquor by the drink tax, and you've got excise tax, and you've got inventory, and like just, and then in Utah, just if we have alcohol at all, we don't even know what to do. So there's so many like just complications. And it's not like you could ever say, like, Stayless, maybe you guys are going to tell me I'm wrong. I've worked with so many PMSs over the year, and it's so hard to expect the PMS to understand and know what every little local territory decided to do this last week and have it updated in their system. No one has it right. And this is not just the hospitality industry, legal softwares, manufacturers, like the big guys that all they do is sales tax, like Avalara and TaxJar, they miss stuff because local counties and cities. So you should always be in the know of what your local ordinance does and not just like turning on your PMS and being like, well, here's what I think it is, because the PMS is only as good as the taxes that are set up in there. Make sure you know what's going on in your city. And I hate to say it, but at the end of the day, that needs to fall on the business owner to confirm.
Yep.
Awesome. Thank you. We do have
And if
another
you live in St.
question.
Louis, you're welcome. Let you know.
We do have another question in the chat. It says, do you see running a business as a corp or LLC? I'm assuming for a better tax setup.
Okay, so once upon a time, corporations were all the rage. They were hits. They were like Tickle Me Elmos, but not anymore. There are only rare cases I like C corporations. First of all, if you are bringing on a lot of investors that are going to be putting money into it, at some point the IRS is going to say, hey, you're not bringing on partners. You're selling a security. You're selling an investment. And at that point, they're going to say you should have been subject to Security and Exchange Commissions. That needs to be a C corporation. And then at that point, it's like, oh, okay. Yeah, C corporation's awesome. There's some weird things where, like, if you used your retirement account to buy your property that you own passively, there's some things called like unrelated business income tax that we might use a C Corp to block higher tax rates down to lower ones. Or if you did this thing called a ROBS, which I mentioned earlier, a rollover business startup. And the reason that's important is because usually you can never buy real estate with your retirement accounts and then go stay at it, work at it, do anything for the benefit or receive benefit of. But then the IRS made this little carve out for what's called a ROBS, where I could take my 401k and buy a glamp ground right now. Those ones, C Corps, ROBS have to be a C Corp. And the only way you as the owner can get money out of it is taking a W-2 paycheck. You can't do any of these tax strategies I talked about, which is why I don't like them. Because often people come to us like, hey, we're going to build this empire and take advantage of paying our kids and do all these other 80 strategies you recommend, Tyler. And it's like, sorry, you don't get any of them because you're a C Corp ROBS. Like, so I don't love them, but if also the option is use your retirement or get a massive loan from the bank that's going to compromise your life, I guess I like the ROBS more. So beyond that, I don't love C Corps. If you don't have a good reason, LLC partnership or LLP or GP structure, LP structure, I mean, talk with your lawyer. But that's my recommendation all day, every day. And might I throw in, and again, this would take me another half hour, S Corps. Do not make an S Corp with more than one owner. If you have a partnership and all of you want S Corps, you should also have your own S Corps that own your interest in that partnership. I mean, I need an hour to explain why, but it makes your life so much better. Just, yeah.
Awesome. Thank you.
Anything
So
else,
Tyler,
team?
again, another question, a
Yeah.
callback from our last session. But back to the accrual cash. This
Yes.
is one of the biggest points of discussion that come up for new RV parks coming on the stay list
Yep.
is, hey, I've been running my business on cash. You're an accrual-based system. How are we handling that? And tax benefit is a big reason for that. And so I would love to hear your thoughts on that, where the benefit is with accrual. One thing that comes to mind that we use an example a lot is you're paying taxes on a cash basis for 2025 for the money you collected for future reservations, and then you get a
Yep.
bunch of cancellations, but you've already paid taxes on all of that. And
Yep.
how is that handled? But I'm curious some other situations there and just how you think about that.
I mean, that's one of the biggest sales. I mean, also, like next in 2 weeks, we're going to talk about metrics, which you can't do squat in analyzing your business without being on accrual basis. But from a tax perspective, yeah, I mean, would you rather have $1 today or $1 a year from now? Would you rather have 1,000 today or 1,000 a year from now? You would always take the money now versus later. And accrual basis, we had one client that, yeah, they accepted 600 grand in advance deposits and wedding event deposits for the following summer. They were paying sales tax in December and they were paying income tax in 2025. Whereas if you recognized it at the right time, you'd be paying sales tax 7 months from now when those weddings happen, and you would be paying the income tax a full 12 months from now when they actually came to stay with you. I mean, not even that, but throwing gift card liabilities, right? We've got some clients sitting on 80 grand in gift cards. The IRS lets you defer those up to 1 year. So if you do a giant Thanksgiving, Christmas push to sell gift cards to get money in, you could get like 150 grand in cash in the business now and then not have to recognize that until next year when people come and stay with you. Like you don't recognize it, you don't pay the taxes on it, you get to sit on the money instead of Uncle Sam sitting on the money. And who knows what Sam's going to do with that? I mean, I don't trust my uncles. So,
Uh, my next question is, from your experience, tax professional, hospitality,
yes.
when you are reconstructing people's financials from a number of different systems and port system tools, what are some of the challenges you have seen versus working with PMSs where you can comfortably rely on the financials?
Oh, man. Okay. So, first off, I mean, yeah, if people are running thing on 6 different systems, they don't talk to each other, and sometimes they're duplicating revenue because maybe they're doing like a concession store in one system, and then they're doing a guest reservation system, and then they're doing a marina system. They're not talking, they're not reconciling, and then they're even trying to like charge guests in one system for what's happening in the other. We've seen clients accidentally double stating revenue by hundreds of thousands of dollars. We've seen it look like cash is going missing. The guest experience is not smooth because usually it's like, oh, I want to charge this to my room. Well, hold on, I'm going to ring you up over here, and then I'm going to ring you up over here. The client experience is just awful, especially because then someone calls in like, hey, I got this charge on my card from you guys. Well, let me go search our three systems and see. So, whenever possible, I love a good integrated tech stack or a system that can take care of all revenue management, especially when it comes to just like having a good payment processor. I mean, my weekend this week was helping a client that needed to get caught up for the year because of this exact scenario. Because it's just they have no confidence in their numbers. It's painful as can be. So I don't know. That's why I'm happy to promote Stayless because it's a selfish promotion. It makes my life easier, and I'm not spending my Saturday nights crying over whiskey in a spreadsheet.
Okay, we're about at time. I have one more question, maybe one and a half I'd like to squeeze in.
Yeah.
One is, what are some daily, weekly, monthly, et cetera, processes that you may not see operators always doing proactively, that if they were to do proactively, it would significantly help their tax strategy execution and make the year end much easier?
Guest ledger all day, every day. So your PMS, hopefully you're on Stayless, but even the best of systems, owners, ultimately you and your staff control what sits out there as like, hey, I'm going to charge my guest for something. Now you need to collect on it. We've had some PMSs where we come in and come to find out their process was someone at the front desk would go add pet fees after the stay. If they saw someone had a pet, they'd go add the fee, $45. It would sit there, but they would never actually run the card. And so it always recorded as revenue. It showed as revenue in the system. And then we get in there and see there are 8 months worth of pet fees, and the credit card authorization isn't good anymore. They missed out on 7 of the 9 months of collecting it. So you want to get in there and check your guest ledger as much as possible, right? For those of you who don't know, the guest ledger is like a glorified bar tab, just saying what your guests still owe you. Maybe they paid for the room and other stuff, but what else do they still owe? I would say that's the biggest thing, closing out night audit in your system, just making sure and reviewing the financials. And lastly, so many business owners look at the P&L and they don't look at the balance sheet. Make sure you, your accountant, someone on your team is making sure the balance sheet is right. So the bank accounts on your balance sheet should match your bank account. If you look at it and there's some weird account you can't explain, that is not normal. That is usually a bad sign. So check all of that. But I know you had half a question. Can we squeeze it in?
The last half question was, you promised two dad jokes, and I think we only got one. So I was
Oh,
hoping to get that last one.
you're putting me on the spot here.
I believe.
Ah, wow, this is tough. The thing is, three came to mind and I can't share them publicly.
Okay, that's fair. That's fair.
I was going to get you
Well,
guys canceled, so I apologize. I'll come ready with more next time.
I can't be
thank,
canceled. I
yeah.
can't go through that, Tyler.
I'll
Please
text
don't.
you, Nick.
Thank you.
Thank you so much, Tyler. Back to you, Corey. I know we're a minute over. We like to be efficient on time, so my apologies for all the questions, but that was awesome.
Yes, and thank you again to Tyler. Again, this is two of our three-part webinar series on accounting, and we'll be wrapping things up on February 24th, which will be our final session. And that'll be the session where we tie everything together and really focus on how, you can apply these accounting strategies in your real-world operations and how you can look at Stayless and connect your financial data to your day-to-day decision making. So, as always, we will send a follow-up with a recording for this email or for this webinar in your email. And we look forward to you guys coming to our last one. So have a good day.